So I thought before I started, I'd give you a little bit of context as to my career, because I've been on both sides of the equation. So I got to Stanford in 1994, which is right around the right time to go, because that's when the internet boom started, or when the internet boom just started being created. I had the good fortune of starting up a company while I was still in school. I sold it while I was still in school. I then did another company and lost all the money that I made in the first company, and that didn't go anywhere. Then I did a third company, which I joined. It was an online content delivery networking company to move video around the internet, but it was 5 years before YouTube, and so there wasn't all that much video. And so we proceeded not to lose a little bit of money like I did with my second company, but a lot of money. We lost $35 million, so quite a bit of money. We eventually sold that business. It looks like a success on my resume. It wasn't a success. We sold it for $10 million, so the investors got back about 30 cents on the dollar. Not a very good outcome. And then I joined one of my angel investors, because that was probably more of a market timing question than an individual performance question. So one of my investors in that business asked me if I could help him out build another business, and we bought out some research in the U.S. and we turned that into a company. We raised about $6 million, and we sold the business a few years later for $135 million, which is a pretty good outcome. Kind of washes away the sins of the previous generation. And the lesson here is, you go through a lot of these ups and downs when you're building companies. And then from there, I pivoted. I went to a big company because I wanted to learn how a big company worked. I spent a few years at Microsoft, and then after that, I decided to join a venture capital firm. And I joined the venture capital firm in London, which is a little bit different because in London there's not a lot of venture money. It's not like California or Silicon Valley, so I got to see a lot of experience. But the firm that I worked for was a Silicon Valley firm. The firm is called Accel. It's the same firm that invested in Facebook, and so it's had a long track record in the U.S. So it was great because you got to see kind of both sides of the world. Nobody told me this, but I decided to become an entrepreneur again. Nobody told me how hard it was going to be to then raise a startup venture capital fund, so really setting up a fund from scratch. So I left and I started up my own fund. It took a lot longer than I thought it was going to be, and so now I'm on the other side of the table, again, investing in companies, but in a brand new fund, so it's a very, very different experience. So that's just kind of context. So what I was going to talk to you today is a little bit about financing. Let's see if it works. Yeah. So the first question is whether venture is actually all that appropriate. So I don't know if everybody understands this. Venture is a very, very unique kind of financing structure, and it's not really relevant for every single company in the world. So I think when you're an entrepreneur, and I was certainly like this when I was on the other side of the table, you try and make sure that you want to get a venture capitalist involved because it's kind of the thing that you want to do. You want to get the stamp of approval, and because a lot of other people have raised venture money. I'm not convinced it's actually the best kind of capital for every single company out there. So I'll give you a few examples. One of the best sources of capital out there, if you're going to set up a business, is what we heard a little bit earlier, is getting money from your customers. If you can actually get money from your customers, A, you get to keep most of your business for yourself, which is really important if it's your company. Two is you have people who actually want your product paying you for the privilege of getting something that you're building from them. And if you can get advance orders of some kind, this is a much better, and it gives you validation. You know that you have a business at that point because your customers are actually paying you. It's really hard to pull off, but it's not that unusual. So I think to me, that's almost one of the best forms of capital out there because you don't have to dilute at all, and you actually get your customers to pay you in advance. It's a very good way of raising money. And the second thing is, I think if you can build a business up to a certain scale and get to a certain amount of profitability and show that you're actually able to generate money, there's lots of other kinds of money that are non-dilutive, non-equity based, like the venture model, which financing of some kind in the form of debt, money from banks, et cetera. And not all of them will give you money at the very early stages, but if you are able to prove out your business, that money does become available. And again, that's a very good way because in that particular case, all you have to do is pay the money back plus a certain amount of yield back to the investor versus actually trying to generate a home run. Venture, and to some degree, angel investment is all about taking a small stake in a company, somewhere between 15 to 30% of a company, but then trying really to shoot for a very, very large outcome. And the reason for that is, how do venture guys actually make money? So not everybody really probably understands this. When you're thinking about building a company, I think a lot of us think about how to build a good company. We think a lot about what's the value proposition to our customers. You know, are we able to build something in the time frame that we want? Are we able to hire really great people around ourselves, right? We don't think a lot about, are we maximizing kind of value? And that's the concept that's really going on through the venture guy's head in order to figure out if you're actually investable. Now, the reason for this is most of us who take venture money, or most of the venture funds who have money, we're promising our investors about a 4x return on our capital. If we're think of it as borrowing. If we're borrowing money from our investors, you know, we want to give them $4. Most of the companies that we invest in will not make us the four times return on a consistent basis. In fact, most of the companies are probably not going to do all that great. You heard my story. I lost $35 million for a couple of my venture firms. You know, this just comes par for the course. We try and do everything correctly, but markets don't often work in our favor sometimes. And so the venture firm typically will have a certain amount of companies that will just never really get there. In order for the venture firm to deliver the $4 back to the investors that they've kind of promised, one of their companies has to do really well. And if you work it out mathematically, and you can build a model to prove this to yourself, you know, what you end up finding is that if you have about 10 investments, you know, and you have one or two companies that kind of go to zero, one or two companies that kind of do okay but not super great, the one company in your portfolio that does great has to do, you know, about a 10 or 12x in order to be able to return money back to your investors. And if you take on even more risk, it's even different. So because of this, and because you only have a very finite amount of investments in a venture fund, they can only write a certain amount of checks before they themselves run out of money. What you then tend to look for is almost every single company that you tend to look for in your portfolio shoots for a really big outcome. And the reason being is you can't really say, you know, this portion of our world is going to shoot for an okay outcome, and this portion of our world is going to shoot for a really good outcome. Pretty much everything has to shoot for an outcome, a really big outcome, and a big outcome being a 10 or 15, you know, 15x. And you know, when you're shooting for something that's a 10x, it doesn't make a difference whether you say 10x or 15x or 20x or 50x. What you're really just saying is if it works, it's going to be really, really big. And that's really what's going on through our heads. So again, think about this. As an entrepreneur, you're thinking about, can I build a really good company, right? You know, can I build something that people want? Can I attract really good people into my company? You know, can I set up a great culture inside the company? And the venture guy is thinking, can he build a really, really valuable company? And these two things oftentimes are the same exact thing, because good companies tend to be valuable, but not always. There are lots of examples in our world where they're really bad companies that turn out to be really valuable companies. Those are really hard to invest in, because if you're investing in something that you know is bad, but the market for some reason, you know, there's a lot of euphoria, and those kinds of companies are going to become really valuable because someone else wants them. It's kind of hard, because if the market changes on you, then you're left holding the bag. And oftentimes the other way works around as well. You see lots and lots of examples, and this is where there's a really big gap between the venture community and between the entrepreneurial community, is there are lots of companies that are very, very, very good. They will build good products. They will find customers. They will build great teams. They will have great cultures. They'll be great places to work for. They'll probably be profitable, but they'll never be truly valuable. And when I say valuable, I mean valuable from a venture perspective. And you know, this is where I think there's a huge disconnect, and this is why I think venture is not often the most appropriate financing for those kinds of companies. If you're able to build a really good company, but for some reason it won't become a really valuable company, it's going to be really hard to attract financing to your venture, at least from the venture guys, because what we're thinking about is this company going to be truly exceptionally valuable? Is someone going to be willing to pay the kind of numbers, you know, that Facebook paid for WhatsApp in order for us to be able to return money to our fund? And so the question then is, what are the characteristics of some of these truly valuable companies? And this is what we spend a lot of time thinking about as venture firms. And you know, when you think about this, most of the common phrases that you hear to entrepreneurs is, don't build vitamins, build painkillers. So what does that really mean, right? Don't build something that people that people think is a nice to have. It's a vitamin, right? Build something that is a must have. And the reason for that is because there are lots of examples of products and services that people, will want, but not necessarily want to pay for. And in a startup market, it's so difficult to get customers to do anything that you really want something that is truly and exceptionally a painkiller. It's the only way to kind of break through the noise. But again, not every painkiller is going to be super, super, super valuable. So what we think about a lot as our fund, and it's kind of our version of the world, but I think it's a shared experience among most of the venture firms, is we tend to look a lot for where are the new markets going to be in our industry. And this is something that it's very hard to figure out as an entrepreneur, but it's a little bit easier as a venture capitalist, right? So when you tend to have brand new markets, so brand new industry categories, you tend to get a lot of value creation at that point. First of all, nobody tends to actually go off and invest in these things. So the bigger companies tend not to go play in the new emerging markets because they probably don't understand them nearly to the degree that they want. The second is that most of the other people out there don't tend to spot these kinds of opportunities. And as a venture capitalist, you get to hear lots and lots of ideas, so you can kind of pattern match and figure out if there's a new market. But then the third thing is, new markets tend to, again, get very, very valuable. So you think back to when the iPhone first came out. If you're building any kind of software on top of the iPhone, whether it was a mobile advertising company or a mobile gaming company, you're going to sit on top of a brand new market creation, and most of the time the market would actually pull you up. In other words, you could build probably a not so great company or a not so great product, but be one of the pioneers in that space. And by being a pioneer, you're kind of riding someone else's trend. So most of these new categories are enabled by fundamental underlying disruptions in our industry. And so if you're sitting on top of one of these categories, you kind of get pulled up. And if you happen to be lucky and you're building a really good company on a really brand new market, right, the two kind of have an amplification effect, and it kind of carries you to success. So again, think back about 5 years ago. This is a company that we had invested in, or a space that we'd invested in ourselves. If you think about when Facebook first released a platform, you could build third-party applications on top of Facebook. And this is when, this is a few years ago, when Facebook was big, but nowhere near as big as it is today. A bunch of people decided that they were going to put video games on top of Facebook. Now, at the time, this looked really silly because Facebook was not a place that you played video games on. Facebook was a place that you shared your photos, you talked to your friends, you updated your status, but not something where you would go play things like Candy Crush or Farmville. And by building those games, by being one of the first pioneers, the three big companies in that kind of category all turned out to have great exits. They built this stuff. And they could have easily gone the wrong way. It could have been that nobody would have played video games, and this is part of the bet that I think you're making as a venture capitalist. But they built on top of this new industry. The number one player at the time was a company called Zynga. It got acquired. It went public, and it got worth about at peak about $2 billion, and is now about $1 billion. The number two company was a company that we had invested in called Playfish. They got acquired about a year later by Electronic Arts for $400 million. And the number three company, and this is the most telling, the number three company built on top of MySpace. I don't know how many of you guys remember MySpace, right? So they got it completely wrong, right? A wrong platform. But MySpace was also going through the social networking boom, and so it kind of grew up alongside of MySpace and got acquired by Disney for $750 million. Half of it was an earnout, so it wasn't real cash. It was based on performance. They never hit their performance metrics, mostly because MySpace didn't really actually do that well in the long run. They still made a $350 million exit. And so again, here's the discontinuity, right? Here was a company that was probably not a great company, who's building on top of MySpace, but became a very valuable company. And it became a valuable company because it was sitting on top of one of these emerging markets. Today, the winner in this space, by the way, is none of these companies. It's a company called King.com, and they did it the very painstaking way. They were a little bit slower to the market. They didn't come in at the onset, and they did it on a pure execution basis. So there's an example of a company that was just very, very, very good about playing the very long road and the long march and winning in the end, which is actually the right way to build a company. But it isn't necessarily always the right way to invest in a company, because that takes a lot more execution and takes a lot more time and energy on the entrepreneur's part. And it's something that, so as an investor, you're looking for these kinds of trends to see if you can actually build something that's super valuable. Again, another example of this is if you're building on top of the mobile advertising space back in the day before the iPhone came out, had you timed this really well, and come up with a mobile advertising product before the iPhone came out, or maybe right before the iPhone came out. As soon as the iPhone came out, consumption of web pages on your phones started skyrocketing. I don't know if you guys remember, the old browsers on the Nokia phones were not very good, right? So if you're building a mobile ad exchange on top of those products, and you timed it right before the iPhone came out, you'd probably be in a market leadership position, and then as the iPhone kind of rode up and people started consuming web pages, you'd be able to ride that trend and actually turn into a very valuable company. And there are, again, examples. There were 3 companies in that space. The first one built on top, caught it exactly the right time and then turned out to be a $750 million acquisition by Google. The number 2 got acquired by Apple. It was a $400 million acquisition. And then the number 3 company is an Indian company, which most people don't even realize today is an Indian company that's kind of become the only independent company. Is now worth over $1 billion. But it's all because of this idea that they were sitting on top of this underlying kind of market creation. Now, the really, really hard thing, I think, as an entrepreneur is to sit down and figure out when these things are going to get timed. I think you can start a company on the premise that these things are going to materialize, but part of this is markets just don't often materialize the way you want them to. So it could have been very easily a case where the iPhone, instead of coming out in 2006, 2007, could have come out in 2009, 2010. And as a result, if you're building a company in that space, you may have ridden the growth, you may not have ridden the growth. So from a venture perspective, we can take these portfolio bets, betting that these markets will actually turn out to be the markets that we want them to be. But it's really hard to do this, I think, from an investor perspective. So we spend a lot of time thinking about, can you create these kinds of valuable companies? And these valuable companies turn out to be, tomorrow's billion-dollar companies. And you need these in your portfolio in order to deliver back that $4 that I said that most of us are shooting for in the 4x returns. So we spend a lot of time on this. And again, back to the timing question, I don't know if you remember the poster child for a kind of dot-com excess was a company in New York called Cosmo. You guys may or may not have heard of it. So what Cosmo did was very simple. If you wanted ice cream at midnight, you could call up Cosmo, and Cosmo would send someone to the store and go pick up ice cream and bring it to your house and then charge you about $5 or something. And obviously it wasn't just ice cream, you could get anything. This was a great idea on paper, and it was lots and lots of money that could kind of get lost in this space, which is exactly what happened with Cosmo. They raised, I think it was a couple of $100 million, and they kind of burned through all the cash. It didn't really work because you were basically subsidizing people to go get delivery. And a lot of this, I think, arguably was timing. If you think back to like 10 or 15 years ago when Cosmo was around, it was before the smartphone. If you're sending around drivers from place to place to be able to go pick up stuff and bring it to someone's house, it's really hard to do and coordinate that stuff over a telephone. It's much, much easier when you actually have a smartphone with GPS in every single driver's pocket. And today, some of the fastest growing companies in Silicon Valley are these delivery companies where they're basically doing errands or tasks for people. And it's all been enabled by this underlying platform. So again, from a venture perspective, you're spending a lot of time thinking about what's the underlying driver in this market that's going to create this kind of value. And again, your timing, we don't know these things. They all look obvious in hindsight. It looks obvious that games on Facebook would work. But at the time of investment, it's not obvious at all. It may or may not actually work from a thesis perspective. And which is why you end up with a portfolio of these things. And it's good for, I think, entrepreneurs to know how venture guys are thinking about this and why we're shooting for these big returns, because it helps you calibrate how you do your presentation back to investors. One of the things that we know as venture guys, if you're investing early in these markets, is most of the presentations that you will see in terms of the numbers, the ability to generate profit, when you're going to be cash flow positive, most of those numbers are going to be incorrect. Because a lot of this stuff is going to be dependent on the timing or the maturation of the market, and you won't know up front if you're going to get it exactly right. So this whole budget, a lot of entrepreneurs spend a lot of time building the financial model, building the forecast, building the budget. Those are mostly useful exercises on an intellectual basis. They force you to think about your business a little bit more rigorously. But we know that until you're actually in market with a product, it's really hard to figure out exactly how the numbers are going to stack up. So instead, what we spend a lot of time thinking about is how can we give the company enough cash for it to go from point A to point B, where at point B, it's made such a step change in its proof that it can show someone that it actually has a product, it has a prototype, it has its first customers, and there's market traction, at which point someone else can then write the next check to be able to get it there. So we think a lot as venture guys about staging our investment. So how do you take it from point A to point B? So, as an entrepreneur, what you should really be thinking about from when you're pitching to these venture folks is, One is, can you prove to them that your market is going to happen and that there's an underlying disruption? Can you actually ride it? And then two is, do you have enough cash, or are you asking for enough cash, or with the cash that you're asking for, can you definitively show that there's going to be a step change in value in your company that will convince a lot of other people who may not believe that you actually have a market today to realize that you actually do have something? And again, the one thing to keep in mind is, when you're talking to venture folks, most of the people are going to say no. That just comes with the territory. And so you only need one person to say yes in order for you to actually have the business. And it's not uncommon in our industry, particularly for these next generation billion-dollar companies, for someone to talk to 20 people, 19 people to say no, and then one person to say yes. Facebook was turned down by every single venture firm in Boston. It came out of Harvard, so it was in Boston. It's not like Boston's a bad place to build a business. It's not a bad place. There's plenty of capital. But every single venture firm said no to Facebook. They had to move to California. And then really it was the guys behind PayPal who wrote them the first check. But then on the basis of that, they were able to show that they were really scaling. They got their next 12 million. At that point, the rest was kind of history. So you have to assume that most people are going to say no. It just kind of comes with the territory. But you need to be in a position where one person says yes and kind of then believes. So the last thing then is, how do you end up talking to these venture guys, right? So you've got a little bit of context now as to what's kind of going through our heads in terms of what we're looking for. Our entire business is based on references. So when you're approaching us, this industry is actually surprisingly small. As in most people know someone who knows someone. So I think over the course I've been here in the last maybe 2 hours, 2 or 3 people have walked up to me saying, you're friends with so-and-so. It's a very small insular industry. And it's actually pretty open in terms of it's easy to get connected to folks. Most of the interesting deals, so every single deal that we've done as a fund, and I'm pretty sure if I did the same analysis of my old fund in Excel, it would be very, very similar. Almost every deal that we invested in came through someone that we trusted who called us up and said, hey, you really ought to take a look at this company. And that person could be someone in the industry who's an expert. They might be an engineer. They might be an executive. They might be a law firm. They might be an accountant. Usually it's people within the industry who tell us that this is something super interesting. Or because if it's a new market that we're following, we might tend to take a look at everything that's going on in the space and just start talking to people. And as a result, we then kind of figure out who are the interesting players. But most of the interesting deals, so I think it's very easy to send an email to, we have an email address, businessplans@Hoxton, to send an email. We read every single one of them. And to be fair, there's some businesses in there that are actually quite good, but it's been very hard for them to kind of cross the bar from an investment perspective because they haven't been in this truly value-creating side. And most of the stuff that we have that's kind of intersected has oftentimes been from references. So if you're building this business, what it really, I think the kind of takeaway is if you're not very well connected in the industry, you have to become well connected in the industry. And I think the best way to do that is what other folks said: build a great advisory panel, build a set of mentors. Those people will have Rolodexes. And again, our business is about listening to ideas and then backing brand new people. I think the average age of entrepreneurs in our fund is in the 20s. We tend to write a lot of checks to younger folks. Most of these new markets that get created, the people who spot them are either really deep experts in the market, and if it's like an older kind of market, they'll tend to be older folks. If it's like a semiconductor market, it will be people with 10, 15 years of experience. But if it's a consumer business, it could be guys, or girls who are like 18, 19, 20 years old. That's not uncommon because they're catching and seeing what the potential of something is. So most of our job is actually listening to people and trying to figure out if they actually have a great idea or not. But we're very open to taking references from other people. And I think that's truly the best way to get in the door. And the truly best way to get in the door is probably what happened, I think, to Anmol here, is you do so well in your special field that other people start talking about you. They may not even know who you are, right? But they're like, that's the company to watch. Like, you kind of heard through the grapevine. And then they kind of whisper that back to the venture firm. And, to be fair, if in the course of a month we hear the same company dropped 2 or 3 times in conversation, as in that's a really interesting company, there are very few of these billion-dollar companies being created every single year. That totally gets us energized, and then we go actively to try and figure out if we can actually invest in that company. And that's the best way to raise money, right? Is when someone then starts sending you emails and giving you phone calls saying, I really want to learn more about the company, and you haven't even done anything. That's the best way, and the best way to do that is to kind of engineer this. And I'm always surprised by how few entrepreneurs actually will then engineer these things in order to maximize their impact. I think there's a lot that you can do behind the scenes to make sure the right people are talking about your company and making these references. So I think that's about it for me. That's a little bit of color as to what venture guys look for and what's kind of going through our minds when we're looking for these investments.